Well, today, of course, is Market Monday, and we're going to be having on a new voice on the podcast today. We've got Shawn Hackett from Hackett Financial Advisors. And Shawn, thanks so much for taking the time to chat with us today.
It's a pleasure. I really appreciate the opportunity.
So before we dive into today's markets, which, gosh, there's a lot of red on the screen, let's hear a quick background. How did you get into the world of commodities? And just tell us a little bit more about yourself.
When I moved down to Florida about 15 years ago, I started working with John Roach, who's a pretty well-known grain market analyst in Iowa. And from there, I kind of learned how the ag trade worked on the ground and kind of developed my skills, and then started my own company in 2007 to utilize some of the indicators that I kind of created, one of them being the Smart Money Indicator, which is one of our flagship methodologies for picking tops and bottoms and helping farmers better hedge their crops and inputs. So that's how we, kind of got into the business and how we've been doing it, and why we're here today, trying to help farmers do a better job. So.
Well, Shawn, not to get you to divulge any proprietary information, but when you're looking at smart money, what do you take into consideration?
We've been very frustrated with how most people look at the commitment of traders, which is the information on every Friday afternoon that comes up with speculative and commercial longs and shorts and net positions. We just felt everyone did a very poor job and didn't really give the farmer a really good look at what it means and when they take actionable, when those movements create actionable things that the farmer should be doing. So what we define as smart money is commercial net positions as percentage of open interest, and then we utilize the 8 largest traders short. And so we bring those two numbers together as a percentage of open interest, and then we put in a relative value kicker in there where we take that and we divide it by the continuous commodity index, which is a measure of 17 equal-weighted commodity markets since 1949, and it gives us what we call our smart money indicator that is fantastic, picking consistently, areas to buy and areas to sell. It's not really meant to be a day trading tool or a week trading tool. That's not really what we do. We're here to position the farmer and the producer for, 2-3 month tops and 2-3 month bottoms so they can take action to hedge. And usually farmers need time to do that. And so this is an ideal indicator for those in the production side of the equation to be able to do that very, very well. And like I said, it's been working for 40 years, we haven't found an indicator that really does a better job at giving farmers a heads up on what the insiders or the informed money is doing in the ag markets that we trade.
Shawn, when you look at the corn market in particular, where are we sitting in the smart money cycle? We've seen, pretty strong rallies here over the last couple of weeks and months, and today we had a pretty down day in the corn market.
Well, I would kind of roll back. We had a major buy signal in the corn market in December, and it had been pounding the table for livestock producers to get, some major coverage at that time. And then in the first half of March, we generated a major sell signal in corn, and that sell signal persisted through March, through April, and through May. And that was indicating that the corn market was likely not to see dramatically higher levels until after it had a major setback, which appears we're currently now under. So really, we're not surprised by this correction. And usually the end of May, early June, crops been planted, it's starting to come out of the ground, you get some good rains, it looks great. I mean, the USDA said last week it's one of the best rated crops so far coming out since 1994. It's not an unusual time for weakness to come into the grain markets, especially corn.
When you look out a little bit longer term, Shawn, how low do you expect us to go on this setback?
We don't think we'll have a lot more to go here on corn. I mean, we're thinking maybe another 10 cents, 3.70 spot price. I mean, we think that's probably the most we're going to get out of this. We think we'll see some very, very strong buying by the smart money, not only this Friday, but probably the following Friday. So we don't think this correction is going to be the end-all, be-all, and we think it's actually mostly already over. This is not yet the time to expect a major high or a yearly high or a run down more than that. We think that it was necessary to do to recalibrate the market, but we think we're probably within 10 cents of the low.
And when you look at the high end of it, is weather going to be what we need to have to put back in a high market? Have we put in the high for this season if we don't have any weather problems?
Yeah, I mean, if we don't get any weather problems, then it's not likely we're going to be able to make new highs in any of the grain markets. We really do need a U.S. weather problem now in order to generate that. It's very early. You know, our weather analogs and weather models that we follow and look at show that we're probably going to have a pretty good year for corn and soybean yields. It doesn't mean we can't have a scare, but, you know, we're not terribly optimistic that this is the year that the U.S. is going to be, you know, provide the big weather-related move higher. But it's still early, and it's pretty unusual not to get a weather scare. But if we did, you know, we just don't think it's, you know, it's going to be a game changer like it was in, you know, South America. If we were to look at a weather problem that might ignite the grains, if we're looking at our crystal ball, we think the Russian-Ukraine drought potentially could be what actually moves the grain markets later in June and July, because right now they're experiencing, you know, a pretty significant drought in the winter wheat areas and could actually transfer into the spring wheat areas. And we know in 2010 when that happened, it lit a fire under wheat and lit a fire under corn and soybeans. So we're actually thinking maybe it may not be a U.S. weather scare that drives the market. It could be Russia. At least that's what it looks like to us right now.
Now, Shawn, you hit on something huge there, which is, of course, we're not just confined to the U.S. anymore. Grain trade is global, and global trade has an impact. When we look at soybeans, we're 40 cents off the high we set, just 2 weeks ago. And how much more can we drop, depending on what happens with global trade and, of course, with China?
I mean, there's pretty strong support at $9.75 on the front contract in soybeans. You know, once again, not a whole lot more downside from what we've already broken down to. Obviously, soybeans is most impacted psychologically, you know, by the China tariff. It's good, it's bad, it's bad, it's good. And unfortunately, you know, we keep going through this back and forth situation with the China tariff situation. We ultimately think it will work out. We ultimately think there'll be a resolving of that, and that will provide a big rally in soybeans whenever that is finally settled and the market's comfortable that we're not going to, you know, slingshot back the other way. But we do think short term, without any resolving of the tariff situation, you know, we probably could see a little more downside to the 9.75 area before we think we could, you know, kind of dig our heels in and set at least a short-term low.
The other big thing I think that we need to make sure we touch on is Argentina buying, you know, the biggest purchase of U.S. soybeans in, I think, 20 years? How much more soybeans will they need to buy from the U.S. to provide some strong price support?
Well, I think, you know, Argentina obviously had a very, very poor, you know, crop, and I just think they're looking to be opportunistic. If they can get soybeans cheaper from Brazil than they can from us, I think they'll buy their needs from them. If they can get it cheaper from us, they'll buy it from us. I mean, I just think they're short soybeans. They need soybeans to make more bean meal and bean oil. And so I think this decline, as we, you know, kind of gain competitive advantage against Brazil, you know, could probably bring some of that buying back in, at least over the short term. And that could be one of the factors that places that low that we just talked about.
Now, Shawn, I want to take us over and talk about the Chicago wheat market. I mean, looking at a chart here on the, on the front month, the July contract, I mean, it appears that we're in an uptrend if I look back just over the past 3 months. And, I mean, it kind of seems as though we're setting right now at 505 against the bottom part of that upward trend channel. Do you think it's going to hold here, or do we have some more downside ahead?
Any market can overshoot a little bit, but I think you're right. I think $5 Chicago wheat is probably a pretty good level. I mean, can we overshoot by 5 or 10 cents on a intraday, intra-week basis? We certainly could, but we really don't think there's a basis for Chicago wheat to go much below 5, given what's going on in Russia, Ukraine. We think that that's going to keep the market from giving way until we can better ascertain, you know, what's going on over there. Because remember, they're now the largest exporter of wheat in the world. And so when Southern Plains gets into trouble like we did over this winter, it's a big deal. But when Russia gets into trouble, it's a really big deal. So we find it hard-pressed to think that the Chicago wheat market's going to give way until we get some clarity on what's going on in Russia and how bad that may or may not be.
Now, Shawn, Because we have you on the podcast today, we know you like to do some specialty crops as well. Tell us a little bit about some of those that you're following. I think you do cotton and coffee and sugar. Are you just doing soft, or are you doing other stuff as well?
Yeah, I mean, we cover all the grains, which include also oats and rice. We cover livestock that we define as lean hogs, live cattle, feeder cattle, and of course, we're heavy in the dairy market, which is a huge global market that very few actually cover that market. And then in the softs, we cover coffee, cotton, orange juice, sugar, and cocoa. So, and actually lumber as well. So we're anything that's ag related that has a futures contract that we can measure with our smart money and get some good fundamental data and get some good fundamental advantage. We try to cover and provide, good advice and analysis for our customers who subscribe to us.
Well, Shawn, then I got to ask you here, this cotton market has been nuts for the better part of the past 3 weeks. We're, at 92 on the front month contracts. I mean, how aggressive do growers need to be selling? Are we in a sell signal here?
We have just entered into a sell signal as of the last week's COT data. So with that in place, we would recommend that cotton farmers now start to make some sales. We still think there actually could be some upside because we have talked about this for many months now, but we've seen very unusually low abandonment acres in Texas over the last 2 to 3 years. And we have said that statistically, there's been very few times when we've had a fourth year where abandonment remained this low and that we were due for Texas acres abandonment to go back to normal or even above normal. And of course now, we have this severe drought that's been going on, and we're clearly going to have a significant increase in abandonment acres. So when we look at cotton and we look at what the market is doing, we think that harvested acres could be below last year with lower yields, which means an actual smaller crop, and the market's been doing everything it could to try to increase the crop size given our blistering exports that we've been having, for the last 12 months. So, of course, it's a great price. Farmers need to sell when those good prices are offered, and we would go ahead and do that, but we would keep a little powder dry because we think there is still a shot at $1 a pound before it's all said and done.
Ooh.
Wow. What about the dairy industry? We, of course, have some dairy producers that tune into the podcast, and we haven't had a dairy analyst on in quite a while, so can you give us a breakdown of what you're looking for some price stability in the dairy markets?
Well, we hit a major low the first week of January. And in fact, that we actually generated a smart money buy signal that week. We actually picked up the bottom within the week. And we've been rallying really ever since. We've been rallying from the low 13s all the way up to $16. And so what we're going through now is a typical, what we call midstream correction in the dairy, for dairy prices. Not unusual like the grain market. You kind of, rally into the spring and then there's some give back into the early summer. We don't think it's over for prices just yet. We think that there's going to be another opportunity for a sizable rally into mid-late summer, and the main reason for this is because California, which is the number one dairy producer in the country, had a very, very unusual reproductive cycle last year where they had a record number of cows in production in the first half of this season and are now drying down those cows, causing a significant reduction in production as a result. At the same time, California has decided to remove VST, which was a milk-enhancing hormone, from the dairy herd. So we have kind of a double whammy here where we expect significantly negative production to come out of California over the next 3 months. That's going to take total U.S. milk production and really keep it under wraps, and that to us suggests that we are likely to have a potential supply schism here, especially with record exports for cheese, record exports for butter, and record exports for non-fat dairy. So what we would say to the dairy farmers is correction is expected, not unusual, but we don't think it's over yet, and we still think they're going to get a good chance to actually sell prices that they can actually make money on.
All right, Shawn, before we let you go, live cattle, are we going to see that August contract trade back below $100? We
don't. We had a fantastic sell signal early in the year, and we were very, very bearish, suggesting a pretty significant decline into the spring, and now we have exactly the opposite situation. We have a significant buy signal, very, very strong. Same thing in the hog market. Those two markets a lot of times tend to go together. We see very, very strong seasonal demand coming in. And we believe that for now, the supply side has been more than dialed in. I mean, I don't think anyone is surprised that we're producing a lot of pork and a lot of beef. So we're optimistic that we can have a rally into the maybe late summer, and we don't believe we're going to be breaking that $100 or $1 target anytime soon.
All right, Shawn, before we let you go, how can folks get a hold of you if they have more questions about your strategies or just want to talk markets with you?
I think the best place is just for them to go to our website, which is Hackett, Hackett, advisors.com. On there, you can download a free sample of our report, a free download of our white paper, and also some other information we have on there. And, of course, they can also subscribe to our service. So we think that's the best way for them to get to know us better and determine whether we are worth their time and effort.
Awesome. Well, Shawn Hackett, thank you so much for breaking down the markets for us today.
Thank you so much, Elaine. Thank you so much, Mike. I appreciate the opportunity, and you have a fantastic Monday.
Well, Shawn Hackett, Delaney, I'm glad to have another fresh voice on the podcast. I think it's always great.
It is great to just get some new perspective because nobody can ever predict the markets 100% of the time. So we just like to fill producers' toolkits with lots of different strategies.
You betcha. And we will be picking up strategies for pork producers this week. That was kind of a tongue twister at the World Pork Expo. Again, folks, find us on Facebook, find us on Twitter at Ag News Daily, or you can send us a message on our website at agnewsdaily.com and make sure we can connect with you.
Yeah, that'd be great. We'd love to see you. Love to eat some good pork products with you. Last year, I think, Mike, didn't you get a pork sandwich or something and you just spilled it all over your pants?
That seems entirely possible. I don't remember it, but I spill food all the time.
Yeah, for sure. Well, it'll be a good time, so we hope to see some folks out there. With that, Mike, should we let the people go?
Let's let them go.